When we have loans on our properties, these properties are considered levered or that they have leverage. So let's first of all define what that means. A simple example, say we buy a $150,000 property and we have a loan of $100,000 and we have $50,000 in equity. The investment is levered because $50,000 worth of equity controls a $150,000 property. So the equity is levered 3-to-1. So what that means is if we get, say, 2% appreciation in that property for a year, that's on the property level. The equity will go up 6%. So it really magnifies the returns, on the way up. It could also magnify them on the way down as well. But in general, over time, real estate has historically appreciated, and leverage definitely plays into capturing some of the overall returns in real estate. So in addition to appreciation, leverage also can have an impact on cash flow. And the impact on cash flow could either be positive or negative. And it depends on how much your interest rate is compared to the yield of the property. Now, it may be that leverage on a property, you are going to get an advantage from an appreciation point of view, and it may end up hurting the cash flow a little bit compared to an unlevered property. It still may make sense to add leverage to the property because you're holding it for the long term and you're expecting the gains on the appreciation to outweigh the hit to the cash flow. So mortgage rates actually have two components that contribute to the rate that we actually pay. The first is the actual cost of the money, and people use treasuries as your base cost. So if you're looking for a 5-year loan, they'll look at the cost of the 5-year treasury as the base. And then in addition, the lender adds a spread. So that is some amount above the cost of the treasuries that contribute to the rate. And that represents the risk that the lender is taking in making the loan. Now, rates are moving constantly. Spreads are also moving constantly because it depends on the state of the market, people's perception of risk. And again, this is referred to as the capital markets. They have been very volatile. It's been one of the most volatile years in history this year, with both rates and spreads moving up and down very wildly. So it's been a challenging year from a financing point of view, and which is why we're continually expanding the number of lenders and financing sources that we're working with. Because again, on any given day, depending on the type of a deal, one source may have a better deal than another, and the money is all the same. We will definitely borrow from whichever lender we know can follow through that has the very best rates and terms.